Welcome to the Patrick Real Estate Show, where we explore the fascinating world of real estate investing with your host, Patrick Switek. Patrick is a dynamic young entrepreneur and an accomplished real estate investor who's passionate about helping others achieve financial freedom. Each week, we sit down with some of the most inspiring individuals in the real estate industry and delve into their personal journeys, lessons learned, and secrets to their success. Let's dive into this week's episode.
Taylor Jones, welcome to the Patrick Real Estate Show. For the people that don't know Taylor, you should, because his LinkedIn is popping off. He's always posting on LinkedIn, and I can't escape any posts on LinkedIn from Taylor. So a lot of great advice, a lot of great stats, but what he's really well known for is founding STR Search, which is a acquisition firm helping STR investors buy short-term rentals that cash flow positive. He's helped 205 short-term rental acquisitions so far, and I'm excited to get him on the podcast to talk about what really makes a property successful versus not. The buy is one of the most important parts of your journey as an STR investor, because no matter how good of an STR manager you are, I know this from being a manager, if somebody has a bad asset, if somebody has a bad home or a product, it's going to be really hard to market it correctly. So without further ado, let's get the first step right and buy right. Taylor, welcome to the show, man.
Patrick, that was quite the introduction. Thank you for having me on. Looking forward to it.
Yeah, man. Taylor made me wake up really bright and early this morning, so that's all the energy you're going to get from me. But Taylor, what's your story, man? How did you get about to in the short-term rental world?
Yeah, so like a lot of people, I was working sales, so lifelong sales guy. COVID comes around and I had a client-facing sales job, so we would go secure contracts, in particularly with the school systems. And I wasn't fired or laid off, but I was told I'm not allowed to go sign new contracts. In short, when March of 2020 hit and the entire spring school semester, it was, hey, you can't go sign commissions and make money, but you're not laid off. We just can't allow you to work. So I was blessed with all the timing in the world, and I was always having that itch for real estate. Wasn't sure what I wanted to do, whether it was wholesale, flipping, burr, everything under the sun. So I was blessed to consume Bigger Pockets, YouTube, read books, everything. And me and my wife have been consumers of Airbnb from the travel side. We actually stayed in over 28 Airbnbs since 2015, quote unquote, an early adopter. I just never ran unit economics from the host side. I wish I'd done that earlier. We might be having a different discussion here today, but came across it and like anything, just dove in, studied, consumed, and I'm really good at taking action. So a lot of people get analysis paralysis. So after about 3 months of deep diving, I was like, all right, I don't know everything, but I know enough. And so started writing offers, and my fifth offer on a cabin in Blue Ridge, Georgia, got accepted. Flew up for the inspection to Atlanta, rented a car, drive an hour and a half, go up there, talk to the inspector, and he's, hey man, it's pretty good shape. Like, it's not bad. And I built out the game plan of what we wanted to do to renovate it, because it was an existing short-term rental, but was not elite by any means. So got the game plan together. And then once I closed, went back up and did the old 2-week dive of overhauling furniture, installing the fire pit, putting in a brand new game room, all the necessary changes, and launched that first short-term rental. And at this point, the job had come back. Florida opened up definitely early there in 2020 in summer and fall. But I remember I launched on a Tuesday because I woke up Wednesday morning and I had over $6,000 worth of bookings. And I was instantly addicted. That's like my taste of short-term rentals and this asset class.
Dude, I think every short-term rental investor, if you've bought a short-term rental and you put all this work into it, especially because it's a shitstorm in the beginning, everything, setting it up, you're probably setting it up on your own in the beginning.
Oh, yeah.
And then when you first get that first taste of the bookings, it's so addicting. Seeing those numbers come up, like $3,000 booking, $1,000 book, like those, yeah, it's like a casino almost.
Yeah, and that was the taste.
Slot machines.
That was the taste, man. And then quickly, and I came into this, I'm just going to buy one a year for the next decade. I keep the sales job and then buy one a year. And of course, that's delusional, because once you get the first one, you get addicted. And then 4 months later, I ended up buying another one. So I quickly
That's
accelerated that timeline. Was like, screw this. I'm not waiting once a year. Like, how do we go get more? And yeah, it kind of was off to the races at that point. And it was really sold me to what this asset class can do for you, both personally and professionally.
absolutely. And so, how many units do you have right now? Or yeah.
Ballooned up to 4, actually started consolidating. I'm looking at going into new construction. So speaking of having the best data, acquisitions, and knowledge, it'd be hard pressed to not put that to work. And so I'm at a place in life where I want to roll the dice. New construction, there's high risk, high reward. So not saying it's going to be easy, but I've made my career buying existing product, and really it was never built as a perfect short-term rental. It was somebody else's vision, a la builder. And I'm going to retrofit and turn it into what is the best possible short-term rental. But it might be inefficient spaces, floor plans, setups that wasn't really optimized for a short-term rental. Because I have all this data, I can go in any market, look at the bedroom SKUs, figure out what's the best, most efficient floor plan, design amenities to make it a perfect short-term rental. Obviously, new construction's capital intensive, so I had to liquidate some assets to free up capital. And currently talking to different builders, looking at plots of land, had a couple under contract and didn't work out during due diligence, but back on the grind here. And I figured I'll learn a lot. And if it works, great. I'll probably only build and never buy again. If it doesn't work, I'll learn a lot. And then I could just go back to buying existing product, which I'm already really freaking good at.
Yeah, I think that is so like exciting. You could just build the perfect like custom. Like this is literally with all the data that supports that this should be a top producing property. But the problem is with existing properties, you're limited to, oh, like this should do this number, but these are the constraints of the property, like maybe low ceilings or something like that. If it was higher ceilings, then maybe it would have done better. So now you can just paint the full vision. This is the best way to test data and see if it actually works. It works. But if it works in terms of creating a new level to that asset class, right? I don't know if you like to do this too, but build STRs where the data can't support like actually what it can do. It's going to do way better than the data actually even supports, but you can't prove it. You just have to do it and create that statistic or that outlier. Do you do that at times with properties?
Yeah, we say this asset class is 80% data, 20% art. If it was 100% data, then you could just plug an address into AirDNA, Rabu, and it would spit you out an exact number, just like LTRs. And guess what? Starwood, Blackstone, KKR would all be in this asset class, and we would all be fighting over 3, 4, 5% yields. Wouldn't be any fun. But that 20% art to this is really where those yields are. And so sometimes you have to take inferences to understand, does this really translate or not? A really good example was those early Blue Ridge days back in 2020, for example. So Gatlinburg on the rise was movie theaters. And I'm like, I'm in a cabin market, couple states over. No one has a movie theater. But if it's working over in Gatlinburg in the Smokies, why would it not work here? And so you have to do a little inference. There's no data that says dropping 10, 12 grand on a movie theater in the garage is going to pay for itself. But then all of a sudden you launch and you're like, oh my gosh, I'm getting outsized returns. And that was the data that we saw. Same thing a couple years ago. We started seeing pickleball courts in Scottsdale in Arizona. So that was pretty standard. I'm like, Florida, Arizona has a lot of overlap, similarly type of market. What if we start putting pickleball courts in Florida? And sure as hell, you got paid out at that same ROI because people appreciated it there. It has similarities. And so I think that's what's really great about studying all these markets is I can understand what maybe works in market A that is similar to market B. And you're using that kind of inference. There's no hard data point that tells you, oh, it's going to drive significantly more, but just things that we've noticed and seen. And that's really led to some really good opportunities. And I think the constant experimenting with data and inferences is where you can really drive those outsized returns.
I love that so much. I will say this is a little bit of a bias, but I do believe full-heartedly that Joshua Tree and a market like upstate New York drives a lot of innovation in this space. Not correct me if I'm wrong, but I do think that there's a lot of things that we see ahead of time and we have been seeing and it works. And then other markets adopt those same principles like a year or two later. For example, I think this is a perfect example is a year and a half ago to 2 years ago, we started, this is one thing that me and my business partner were like, hey, this geodome is perfect for stargazing. This would be amazing. Let's put this at our property and let's see just how it does. Like, it doesn't have, whatever. It doesn't have to be the first image. It could be the third, fourth. And then we made it the first image just to A/B test. That property went bonkers. That property, like nobody has ever seen it. Stargazing dome. It went from, we were booked, this 2-bedroom property, all in $500,000, was produced, was still producing this day actually, $160,000 a year. And that's just like crazy. That was just the first year. And I have a whole video on this breaking it down, but that dome was a big part of it. And so the first picture was a dome, beautiful lights around it, illuminating with the sky in the back, with the Joshua trees. Like, it was insane. And so since then, we've done it again. We've taken the dome and put it up on top of now let's add some elements to it. Let's add like a backdrop with boulders and beautiful views. We added on the top of this hilltop. Boom, that property is a top performer. It's outpacing every other 2-bedroom. Did 10,000 its first month. And we're going to get higher numbers. But anyways, I 100% agree with that inspiration, grabbing that. And now Bill Fate's like, where'd you get that dome? So he's putting it in his property. And all of a sudden he's got a dome. And now everyone's asking about the dome. And now everyone's trying to copy it. So it's funny to see how that works. But I'm all for it. What have you seen from other markets, maybe amenity-wise, that you've taken inspiration from for yourself?
And so physical amenities is obviously, you could talk about things like movie theaters, pickleball courts. We've done golf simulators and garages in markets where it is maybe golf forward. But I also think it's just physical property. So again, we talk about buying somebody else's product. Maybe you start to learn hedges. And one thing you talked about was high ceilings. And in certain markets, that is actually an ROI driver. But it's not a blanket statement. So when studying some of these mountain markets, for example, we've seen a correlation between ceiling height and top performers. But you can take that inference and then you come into a market and you're like, let me test this theory here. Different mountain market, and you're like, doesn't really have a correlation. And so that's what's interesting. Every time we go into a new market with data, you have to come in with no biases, because just because something worked in there, it's not a guarantee that it will. Now, we can use directionally correct inferences to find out, but it's never a guarantee. Another thing we picked up on was the size of your deck. And yes, I want to make sure you heard this correctly. The size of your deck.
Energy.
Big deck energy. Yeah, I've posted this before. But we started seeing a correlation is how large the deck space is for people to gather. And when you take a step back, it actually makes sense. Do I want to sit on a small, cramped, like 5 or 10 foot deck where you get that claustrophobic feeling, and this doesn't really work. And so naturally the 20, 30 foot deck, you're like, oh, this makes way more sense. I can have more loungers, the hammock chairs, the eggshells, whatever. And you're just seeing that direct correlation because I can put more things on that deck for people to enjoy. And so it's really never anything you have to have a PhD to figure out, but it's just looking for what are those little subtle differences that are going to move the needle. And so I think that's the dissection is you can run the amenity train of, oh, what's the next amenity that's going to be there? But I think it also just starts tying into the physical features of the home. And again, unless you are building from scratch, when you start buying, you want to try to buy similar type of products, a la high ceilings, a la huge deck, or budget 10, 12, 15 grand to rip out the old one and put in a bigger deck. So those are the things that are just going to give you that outsized return, is understanding what the common features of the top performers have in that market and being able to execute it for your property.
Yeah. Oh, 100%. And let's talk about all that, what it takes to, let's drive it back, right? Let's go back to just the first step. You're looking to buy a property, you choose a market, right? At that point, there's a lot of, I don't know, do you help people choose markets too?
Yeah. We've studied probably 349 markets. So it's just helping people narrow down what aligns with their goals and interests. What do you like? What do you not like?
That's like a Kenny Bedwell kind of thing too.
Yeah, absolutely.
But I think really I think you stand out more than anybody is like really building these incredible backyards and having the data support, not only the backyards, but like the whole experience, right? So let's say we pick a market. The first step is picking a property, right? We pick the market, we pick the property. I'm assuming you look through the data and figure out which property makes the most sense based on the data. Like what's most popular? Like in Scottsdale, has to be over 4 bedrooms, I heard. So I'm curious, like, how's
Yeah,
that play out?
absolutely. So I think we'll start first and geographically, it's just chart out the top 25%. So where do all the top performers lie? Are they all on the north side of town? Are they equally spaced northeast, southwest, and directionally actually doesn't matter? Those are the first things to figure out is where are all the top performers lie? So once we can start there, then we can understand, okay, what are all the common trends? And so you will go through the amenities list. And so we're going to build a kind of a commonalities list amongst those top 30, top 40 producing listings and say, okay, hey, if 28 out of 30 have a hot tub, that's table stakes. If only 2 out of 30 have a hot tub, it's maybe not necessary to win. Could be a good idea to differentiate, but not necessarily a guarantee. Shameless plug, the post I put out today was swimming pools in Asheville, North Carolina. So if you actually look at the 30 highest revenue producing properties in Asheville, regardless of bedroom count, only 1 out of the top 30 has a swimming pool. So sure, pools crush in Arizona, Texas, Florida, a lot of other markets, but it's actually not necessary to win in Asheville. Now, on the flip side, you could point to, that's a great way to differentiate. I'm like, yeah, true. If your property has it, I'm not going to rip it out. But I also don't know that investing 50 to 100 grand, depending on the type of pool, whether you do a mod pool, in-ground, gunite, etc., is really going to pay you off on that ROI. And so that's just understanding the data and the unit economics for what's really necessary to win and what's not. So when I start building out that commonality trend, I'm going to understand that. So now I understand what amenities, I'm going to look at what the design style is. So is everything modern blacks and whites? Is it boho chic? Is it a bunch of pink everywhere and naturally people are leaning into groups of women traveling? What do these look like interior wise? Sure, I'm going to understand geographically. Then I'm going to understand the amenities. Then I'm going to look at the design style. Then I'm going to look at the physical structures. Is everything modern? Is it vinyl siding? Is it cabin? And so when you look at understanding what's the physical bones, you can draw what is a blend of the top performers. Then I want to go to Zillow and reverse engineer. Can I buy what looks like, has the space to add? Design's easy. You can always design it to be a top performer based on there. But do I have the room to add the proper amenities that are needed? Am I in the right geographic area? And does the physical exterior match what's needed? Can it be anything? Does it have to be cabin feel? Does it have to be modern? What are those common features? And again, that's all going to be market by market. So once you decide on, hey, I'm buying in Austin, Miami, Joshua Tree, Biloxi, Mississippi, insert market here, doesn't matter. You need to run that same process of where the top performers located, what amenities do they have, what's the interior design style and target demographic, and then ultimately, what's the physical bones of the properties look like so that you can go in and reverse engineer on Zillow to see what can you acquire that gives you that shot to check all those boxes of the top performing properties.
Perfect. So you're saying that, okay, if I see a property that's a 5 bedroom, has an in-ground pool, has views, and you buy the same 5 bedroom in-ground pool with views, maybe not down the street, but maybe like a small little, like pretty close by, like within maybe 2 miles, there's a pretty good chance, as long as everything else is semi-similar, that you're going to produce as much as the other property is going to produce.
Yeah, that's the straightforward way. And what I always say is try to replicate and then add 1 or 2 twists to it. So cool.
That's
If
what I was going to say.
everybody's got pool, hot tub, fire pit, game room, I'm like, cool, that's my table stakes. But then what if I come in and add outdoor bowling? What if I come in and add a horseshoe pit or bocce ball or a 6-hole miniature golf course? Like, what's my little extra? Because at the end of the day, you're going to get booked from a customer standpoint with outsized ADRs for one of 2 things, luxury or value. So if you're playing in the luxury bucket, which is a segment of the Joshua Tree market, for example, great, you're competing for that luxury traveler. Everybody else, if you're non-luxury, is value. So how do you provide value to consumers? Typically, it's offering them a lot of different things, a la amenities, that they can't get in another property. So if I can provide more value to the consumer, I could charge more per night because they see that value there. They're like, oh my gosh, like the kids are occupied with A, B, and C. It's the whole thing with too. So take some of these vacation resort communities that have a community pool, and it's, yeah, great. But if you notice, everybody who has a private pool is getting insane outsized revenue nightly rate. And it makes sense. Do you really want to load the car, with the kids, the cooler, the towels, drive 5 minutes to the front, and then you can't really relax because you got to keep an eye because there's 14 other families with kids there. And you got to make sure rather than you don't even have to put flip-flops on. You got your cold beer in your hand. You can walk 10 feet out the back patio and sit and relax and watch the kids at the private pool. You'll pay an extra $30, $50, $80 a night all day for that convenience. And so it's just understanding those little metrics. And that's how you can build out a winning property no matter what market you're going to go into.
I agree. Totally. Dude, you're taking words out of my mouth. So in that case, granted, we did talk about you adding those 2 extra amenities. I'm going to challenge you now, Taylor,
Okay.
since I have you on here. But there's a lot of talk about, hey, when does it stop? For example, I put in a pool and a pool and a hot tub. Now I was dominating the market. Let's say I was dominating the market. Two, 3 years later, everyone's got a pool and a hot tub. And now it's like I'm just another pool and a hot tub place, and my revenues are going down because there's these new properties are coming up with even more stuff. And so I have to invest and try to get a movie theater and do this and differentiate again. And then once again, I'm behind and I have to continue doing it. And so like, when does this race of playing against Jones, right? I have a lot of clients that ask me this question. So I'm curious, like, how do you go about answering that?
Yeah, we're taking the approach of maximizing on day one. So obviously I can't pick up my fence and move my property line, but can I fill and allocate this with almost what some would call over-engineered? But you know what this gives me? It gives me a 5-year, 7-year runway where it's pretty hard to get caught. Secondarily, it is going to require more capital. That's going to naturally eliminate competition. Not everybody's going to be willing to spend 25, 30, 35 grand for a pickleball court. Not everybody's going to drop 10 grand on a miniature golf course. Not everybody's going to put in an outdoor bowling alley per se, or the movie theater. So almost setting up day one for success, you look so much far and above the competition. But what it also does is it protects you in a recession. So what I tell people, your biggest risk in a recession isn't that your nightly rate goes down. It's that you sit vacant. And what happens is rich people still travel. So if you look at every recession, there is still hospitality and travel that goes on. But what happens is the bottom segment of the consumer stops traveling. So whether that's the bottom 50%, 60%, 70%, if you're a bottom 50, bottom 60, bottom 70% property, you sit vacant. Rather than, hey, I'm in the top 10, top 20%, guess what? They still get booked. Now, maybe when times are good, they're getting 700, 800, 900 a night. And now that it's quote unquote a recession, you're only getting 400, 500, 600 a night. Guess what? You're still covering your monthly bills. You're still making some money. You're not rich with money falling out of your pockets. But if you ride out that recession, which typically is 10 to 18 months historically, then you have the ability to emerge in a much better position because you didn't have to let go of the property. You didn't have to tread water and burn cash for 10 to 18 months. So to me, your biggest risk of not optimizing on day one isn't that, oh, I got to reiterate in 1 to 2 years. Like, sure. Your biggest risk is in a recessionary environment, you sit vacant. It's not ADRs going down. So to me, I'm always been of the camp is to do more upfront. And again, maybe your competition has 3 amenities. It's not necessarily I'm going to add 4. Maybe I'll add 6. Deal. And again, it's market by market, but it's just continuing to bring those layers that stand out. And we've seen it directly within some of our own acquisitions where, like in one of these pickleball heavy markets, for example, the all else equal, both 5 beds, both have pools, both have hot tubs, both have game rooms, pickleball versus not. You're just seeing that in off season, these are holding up really well. These are struggling to get booked and at low ADRs. And so you can just take that correlation and spread it throughout the whole market. So to me, I think it's better to invest more in day one than you think. It gives you a lot of runway and it gives you downside protection in a recessionary environment, but I'm not oblivious. It costs capital. It's not cheap.
Yeah. So what do you think about this? Is funny because you'll probably laugh because you probably heard this before too. I'll make that investment once I make money later, right? I'm in a hole. I'm not making as much money. And I'll make that investment later once I start making more money. What do you think about those kind of quotes?
Yeah. Depending on your amenity, it will 9 times out of 10 cost you more to do it later. Let me go to the extreme, the pickleball court. So We're not a fan of sport court. It's got tons of issues. I know it's cheaper, but when you talk about maintenance and client satisfaction, you'll quickly regret it. So you do cured concrete. So that concrete, to do it properly, has got to cure for 28 days. Then you got to paint it and put a clear coat on it. So if you do it up front when you're not live, sure, it costs you a month of time and roughly 30 grand, depending on the market and the size of the concrete. If you wait and you close down your listing, and let's say you're averaging 10K a month in revenue, now that taking that time off, it costs me 10 grand plus the $30,000. Same thing with the hot tubs. Now, is there things you can maybe do in between guests? Absolutely. So that's another thing when you're strategically picking what to defer. There's some things that will cost you more later. That pickleball court will cost you more. That private
is like the biggest thing.
You have to do it on day one. Like you don't, It's not even optional because it's not 50 to 100 grand. It's now 100 to 150 grand if you're going to go close down the listing for multiple months. Again, maybe you can get a crew to set up the playground. You get it shipped, you get it held, and a 2-man crew can rip it on a Monday, Tuesday when it's vacant. Sure. So there is certain things that you have to realistically understand. Do I need a permit for this? So if it's a hot tub that requires an electrical permit, that could be 2 days to 2 weeks, depending on your market. So those are things that you're going to need to be on the lookout for. Are you adding in a game room? Do you need to paint murals? And the muralist takes a couple days. Like all these things you have to understand is how long do they physically take to execute? Because if you do it later, it costs you more money because you have to close the listing down. You have to make blocks. And the $4,000 muralist now costs you $6,000 because of the closing of the listing. So all things that you have to look at on day one and really understand before you go live, it's going to cost you a lot more money down the road.
So let's digest that. So my rebuttal to that is, wouldn't it cost you the same anyways? Let's say it takes a month to do, let's just say it takes 3 months to do a pool, right? Or 3 months. Okay. So either you can do that, you can go live early and make money right away, or you could do those 3 months either while you're live or before you go live, but either way it takes away 3 months from the home, right? Essentially.
Yes and no, but simultaneously, you're probably also doing other renovations. So if you close down the road, it's just the pool, assuming you're not adding anything else. If I'm doing that, I could also be ordering my furniture, which maybe the sectional's on a 2-week back order. I could also simultaneously be interior painting, ripping out the carpet, installing LVP. I could be running things simultaneously. So it's not necessarily that everything's its own isolated 3 months, is that I could do that simultaneously. I think second is you take a listing that has a lot of momentum built up and then you kill it. Yep. And then to try to restart it rather than, hey, I'm going to run my normal listing ramp up period, call it 3 to 6 months, depending on the market, you as an operator and when you launch, that once I can hit my stride, if I don't have to close, I get to keep riding my wave, stack my reviews, build my ADRs, being favorable on the algorithms. So to me, I just think the pros outweigh the cons in all of those fronts rather than, man, I'm cranking for a year and then I'm going to close, kill my momentum and have to almost restart again and drop in and revamp up the reviews again, get more listings and bookings, jack my ADR back up to where I was and higher to overcompensate. I think it's a tough uphill battle.
I also think one thing we haven't mentioned, and this is like what kills me always, and this is my argument, is I'm looking at them and I see that you make 2.5x more with the pool in the summer versus a cowboy pool in the Joshua Tree market. At least that's the data across our portfolio. And so I've done the data. And so I show clients this and they're like, no, we'll do it later. And I'm like, if you just did it right now, we could be making, you could pay back the pool. And I literally looked at the math. You can pay back the pool 1.5 to 2 years, depending on what pool you get and how you do it. I'm like, it's just so, like, why wouldn't you?
Yeah, the numbers are really good if you leave your emotions out of it. It's the same thing. We ran analysis in Scottsdale. So 4 or 5+ bed larger homes, the pickleball court is worth on average 58 grand in additional revenue. So again, depending on cost of your labor, who you hire, you're going to be 40 grand tops, if not low 30s. To me, it's a no-brainer, but to not put one in, or to the conversation we talked about, nailing the buy side. If I know that the court is 22 by 44 and then I need a little bit of excess space for the serving, so I need arguably a 28 by 48 space, give or take, I'm not going to buy something that doesn't have arguably at least 50 feet of length in the backyard because I'm setting myself up for failure that I can't even install it. And you said this off the jump and I didn't even comment on it, but this is the quote I tell people. I don't care if you're the president of the Ritz-Carlton. If you buy the wrong property in the wrong market, doesn't matter how good operationally you are, you're going to struggle to be profitable. However, you buy the right property at the right price in the right market, you can screw up, trip, scrape your knee, mess up the hospitality and still make money. Yep. And so the buy side is so important. You know, your debt is with you no matter where you go. That physical asset, you can't change the physical structure. Sure, you could continue to add things to it and elevate design. But at the end of the day, if you bought on the wrong part of town, you bought too expensive of an asset where debt is weighing you down, I don't care who you are, whether, you know, the president of the Ritz-Carlton of the Four Seasons, like you could be the best hospitality operator in the world. You're going to struggle. So nailing the buy side is so important, and it gives you a lot of room to screw up downstream, and you can fix operational issues. You can get better at guest communication, your response time, providing value to guests. Again, you can't outweigh bad debt or the wrong side of town if all your comps are on the north side and you bought on the east side. You're just in a load of trouble.
Music to my ears, man. You know how many times I get a product as a manager and I feel like I'm pretty good at what I do. I'm like we're top dog. We're good. We're good at what we do. We come in, we're gonna make you money. But dude, I deal with these clients a lot, like clients like this where they will buy something and I told them, I'm like, hey, don't buy it in a neighborhood. Trust me, this is not going to be good for you. And they're like, no, we don't want to be on a dirt road or out there. We want to have something close to town. And I tell them against it. And then they complain to me why they're not making as much money. And I'm like, I'm topping out how much money you can make for a property in this area. There's nothing. They're like, what can we do? I'm like, there's nothing you can do. I don't know how to say it to people like that, but I hate saying it, but it's true. Like, you bought wrong. There's nothing I can do as a manager. And then I get pinned as the bad guy because I'm not making them enough money, because who else gets pinned? And so that's the hardest thing. And so that, I'm so glad you said that. The owners that come to us earlier, we tend to like guide, because at the end of the day, we're incentivized to guide them to make money.
100%.
Right? So we're like, yeah, do not buy that. Buy this 100%. And those people end up doing really well, the ones that listen and at least some guidance. Hey, do this, don't do this. But yeah, that is because I know how much of a PITA that person's going to be every month when he's losing money and come to me saying, why am I losing money? It's, dude, you bought wrong. But that's a hard thing for the ego to take as well, right? Nobody wants to be told, hey, you bought a wrong asset. They're just like, what can we do with what we have? Maybe you can add a pool, but then they're like, we have to invest more money. And it's just this loop of what better marketing can we do and what better pricing can we do? That's the things you want to control. So I'm going to ask you now, Taylor, I'm off my soapbox. That was my complaint.
Oh, that was beautiful. That was great to stand down here and witness it.
Yeah, but I'm curious, let's say you didn't buy correctly. Let's ask you this question. Is there a diminishing return on an amenity depending on location?
Yeah, 100%. You could look at a house and talking to a professional like yourself who owns and knows the local market really well is really what you're going to have to understand, because it might not make sense to invest any additional capital, period. So maybe you do have a couple amenities, but you got room for more. But just based on the property, it's the wrong bedroom count, it's in the wrong part of town, or it's just the wrong structure. I'd also say it's just better to cut your losses, air quotes. Maybe you're not losing money, maybe you are, but I wouldn't want to spend into oblivion when I know that I am capped out. And some people might ask, how do I know I'm capped out? I think you have to really talk to a data expert or a local operator to truly understand, hey, is this in that position? So you would be able to obviously tell people for your market. And if there is some room to grow, I think it's what's the strategic ranking. So if I'm in a family forward market with young kids, maybe putting in a playground for $4,000 to $6,000, not the rinky dink ones for a couple $1,000, but is a good investment that I could differentiate. Maybe I should add a better game room or add a mural to stand out. So I think there's just things as strategically investing your capital. I've also taken the approach too with people on a budget is You want to overwhelm with volume. Again, not necessarily an ideal strategy in a luxury market, but if you're competing on value, look at things like putting cornhole boards out, giant chess, the giant Connect 4. None of these cost that much money, but when you can spread them all out around your property for photos. The worst thing I hate is like you have cornhole and the boards aren't out for photo time, or the chess pieces aren't stacked up, or the bocce ball or the horseshoe ring. You could set up the little square with the sand, stick the stake in, put a little border. So there's a lot of things you can do for under $1,000, some couple hundred, and it visually fills your property. And that's going to at least allow people to think, oh, there's a lot to do. Now, granted, are these huge over-the-top things like a miniature golf course, like a playground, like a pickleball? No. But if you're balling on a budget, there's a lot of things you can do for quote unquote under $1,000 where you're just providing more value with extra things, and then showcase those in the photos, display them everywhere, a poker table, big stack of games, different things like that. Again, asterisk on luxury type properties, because that's not going to be a winning formula. That's a different approach to win. So those are things I'd be looking at if I had a struggling property is, depending on my budget, is there things I can spend 3, 4, 5, 6 grand on that are going to be big returns? Or do I really not have that capital and I need to figure out how do I buy this cornhole set for 150, this giant Connect 4 for 150, giant chess for 800, and really just fill with volume and try to get my listing boosted. To be honest, too, new photography goes a long way. I don't even think people realize this. 9 times out of 10, the reason your property's not doing well is your photography isn't good. And I think I've been blessed when you start looking at 50 to 100 listings a day to run comps across the US. I've seen what the creme de la creme looks like. A lot of people don't know. It's kind of like wine. If you've never had good wine, you don't know what good wine is, or good coffee, for example. So some people look and they're like, oh yeah, like my photography is good. And I'm like, dude, this is a B- at best, but that's because I've tasted the A+, the creme de la creme. And I've seen some of the properties that you've posted that you guys are managing. And I'm like, A+ photography, like, yes. And you'd be surprised how many elite investors have 2 photo shoots on their properties. I don't think people realize this. Yeah, sure. And then you almost combine, okay, I have 10 living room photos. I'm going to grab the best 3 out of each. And it might be one from this guy, one from this guy, or one from this gal, one from this gal. I've got 18 backyard photos from my 2 sets. People get all the way to the finish line. You're spending hundreds of thousands of dollars for physical real estate. And we're going to skimp on the $500 to $800, maybe $1,000 creme de la creme person. And
that blows my mind.
People were shocked when I posted this. I said, I would happily pay 2 G's for professional photography if I knew it was an A+ guaranteed photographer. And Taylor, people are like, oh, Taylor, that's so I'm like, no, you don't understand.
No, you don't.
That is a bargain for that person. And there's some markets, like, shout out to some of our Florida photographers and other people that we've built really good relationships with. Like, some of these guys, I don't want to tell them they're undercharged because then they're going to start charging more. But I'm like, dude, you don't miss. And I don't think people realize, and there's some of these guys who have social media presence. If you're in some of these Facebook groups, you'll know who they are. And you would gladly pay $1,000, $1,500, $2,000 to guarantee success, because people book with their eyes. It's like a buffet. You grab with your eyes visually to fill your plate. You book with your eyes. And photos.
It's not like Zillow, right? Zillow, you get the chance to see the property in person. You don't. You have to buy through emotions. Like, you're buying right in the spot when you go online and you take out your credit card because you see the photos. That's what it is.
Yep.
So
it's so true.
Crazy. But we spend over $2,000 on our photos. That's why when you said that, I was like, oh yeah, all day. And what's funny is I tell her, I'm like, listen, like, you could be charging more, because the crazy thing is, it's like more than 2,000. Yes, hot take. Yeah. Freaking hot take. Cut this thing right now. But yeah, like $2,000, because that is what it takes to perform at the highest level. And we take properties where we do nothing else but just better photography and better pricing, and we can do 3x their revenue. We've done that before. So there's 100%. I love that you said that. It makes me feel a lot better.
Yeah, Patrick, take it to people selling their houses. That's why I roll my eyes. It's just human nature. Yeah. Let's just say you're selling your house and you got plastic Formica countertops.
Yeah.
Most people won't go drop $10,000 on new granite knowing that, hey, I invest 10 grand, I can probably list for $20,000 more. People are just like, oh no, I just don't, I'm walking out the door. I want to spend money. And when I sold my first primary residence, I got really good advice from a local realtor. And he's like, hey, here's what we're going to do. We're going to go buy, there's this paint called bright white. And so it like literally makes the house look really bright. So we're going to paint the whole thing. We're going to swap out all the vanities. So sure, one of the guest bathrooms wasn't updated, but he's, hey, new $500 vanity, new light, new fixture. And it just puts those little pops in. So I did a 1 week bender investment before selling my first house, dropped about $6,000, and right before list, sure as could be, the first weekend had 4 offers over list price. And it's just, man, look, the walls were beautiful, bright white, fresh coated in the photos. There was new light fixtures, now sure, was the shower tile outdated? Yeah, it was vintage from the 80s, but it had a brand new vanity, a brand new light with a black trim mirror on it, and the brand new light fixture. And it's just, people don't understand this. And so investing $2,000 on an asset that's going to generate 150, 200,000 in top line revenue. Are you kidding me?
You're going to skimp on that one little thing. And so this one thing I'm going to say also, I think you're notorious for this. So I'm just going to literally put it. It's funny because in my market, there are people that recognize your designs and recognize what you do. And so there's definitely some people that are like, I don't fuck with that. I don't like what he's doing, whatever. But then the data shows it works, and it's what people want. And so, that's not. What's up? So I'm going to just say the colors, right? Yes. The colors, man. Oh, I don't want to make all these different bright colors and it's just too much. And so there's a lot of people that are like aesthetic and I'd rather go for the aesthetic. I respect that. I respect those people. But then you are the person that just goes, I've seen all sorts of fucking colors. I've seen rainbows, and I'm curious, what's your philosophy there?
Yeah, so we've niched down. Now, again, if we ever did Joshua Tree, we would not do this design. So this is the thing. It's not universal, and I don't think people realize this, but we double down typically in family forward markets with a secondary pull of groups of friends. And everything is about standing out. And at the end of the day, people are scrolling through a sea of listings. How do they stop and click on yours? And I think the term that everybody uses is stop the scroll. How do you stop the scroll? And so again, if everybody else is modern black and white or the boho chic look, and then you got these pops of yellows, oranges, pinks, and reds, it stands out. It's reason why every pickleball court, I say, is not the government colors. So if you go to every public park, it's green with the blue. That's the government courts. And so the first thing some people try to do is they're like, oh yeah, I'm just going to paint it green and blue. And I'm like, no, that doesn't stand out. That's no different than going to the community park. It's the government's colors. So I say. And so you get that to stand out. And all of this we've A/B tested. That's the beautiful thing of several hundred of these over 3.5 years is you get to A/B test. And we start to, at this point, try to launch with one new idea iteration. So we try to test what's one A/B test we can do here to learn. Like you've seen those bunk bed slides. So like that was a test one time is what if we put a slide in the bunk room so the kids on the top can slide down? Sure, those slides cost like HEs. They're not cheap, but it was a test. And then all of a sudden, the regular bunk rooms in the 4, 5, 6 bedroom houses that sure are going to accommodate the kids versus the bunks with the slides are booking at insanely higher ADRs. And you're like, oh yeah, now it's like, why would I not put the giant slide in? Because it stands out. And so those are the things that we typically focus on because we know they continue to win. Again, if I was going to the Catskills or the Adirondacks, if I was going to Joshua Tree, that would not be the design style. We're just not in those markets for various reasons. And so like you have to design for that market to understand. It's also the type of product. If I was buying smaller units to appeal to couples, that's also going to miss. We're typically buying 4+ bed, 4 to 7 bed type spreads. But if I'm buying a 1s or a 2, I'm going to design completely different because I need to nail my target demographic, a la couples or couples with 1 to 2 kids.
Why would you do we've done pickleball courts in 2 bedrooms, but like a 1 bedroom, I don't think it makes as much sense to do a pickleball court. All these gamification and all these, what are you going to do? You and your significant other are going to like play all the games alone? I don't know. It just seems weird.
Yeah, no, that's it's a really good point. It's just going back to nailing the target demographic and what does the data tell you and just go execute better than anybody else.
Facts. Dude, this has been awesome. I do want to get into the last three questions here.
Beautiful.
Wrap this up. I feel like we can chat a lot more longer, to be honest. But wrap this up. First question, is there like an educational resource or a book or a YouTube video or something like that really hit home for you that made you either go into real estate investing or change your life in some respect?
Yeah, like everybody, I did the classic Rich Dad Poor Dad,
Yeah.
which really was a mindset shift for me. And I think COVID was a little bit of a mindset shift as well. Was I was trading time for money. And it's kind of interesting. My parents growing up and my parents' generation, and they were getting it downstream from their parents who did deal with the recession or the Great Depression more in particular. And so everything was like save up, invest, and then draw down your retirement. And to me, I'm like, I always felt that was backwards. I'm like, wait, how do I know that I have enough saved? How can I do that? Rather than if I invest in assets that pay me, I know roughly give or take. Now, sure, it might go up a little bit, down a little bit on a yearly basis from a yield standpoint, but the asset values are going to hold some level of value and they're always going to be there. And then again, if you needed to liquidate, you could.
It was like a mini bank, like you were buying mini banks that you can always tap into the equity in those banks to be, and they go up in value. It's cool. And you get tax advantages.
That's the eighth wonder of the world there.
Cream of the crop.
Yeah.
Cool. What is the future of Taylor? What's Taylor's future look like versus or the industry? What do you see as the things that people are going to be investing in or doing in the near future of short-term rentals?
Personally, I think I'm hopefully building custom short-term rentals throughout the US and have a really good portfolio of probably somewhere in the 6 to 12. I'm not a go grab doors guy. I would rather sell my 150K revenue property and find something generating 200 grand in revenue per se. So I'm not a door chaser. I'm more of just a like, how do I get the most with less? You have less homes means less guests checking in on Friday nights, less roofs to replace. So if you can make the same yields a la higher revenue properties, which is why I'm probably going to be building nothing but 4s, 5s, 6s, and 7s just to go chase the revenue on a bigger scale. That's probably me personally. In this asset class, I see a lot of maturity, and you did see that in 2024. Cream was rising to the top. Professionalization, operators like you guys and others started really separating. And that's what we noticed was the top 10, top 20% continued to grow. The people who were complaining about bookings being down, everybody was hanging in the middle 50%. And what happened was the top 20% was gobbling up the bookings from the middle 50%. So to me, I see another layer of maturity and separation in this asset class with further professionalization. It's going to mimic what happened to, say, self-storage in the early 2000s. Ton of mom and pop operators, and then institutions, professional operators coming in, using dynamic pricing, updating rent rolls every 6 months. You increase the price because you just know statistically people aren't going to move out. So it's a lot of the same traits if you go look at other asset classes, a la self-storage in the late 90s, early 2000s. How's this new asset class that is short-term rentals? A lot of mom and pops, professionalization starting. And I think that's just going to continue over the next 2 to 3 years.
Yeah, I agree. And we see that the middle is getting squeezed out, the Sears of the world, right? The middle, like you're not value or price driven, you're just in the middle.
Yep.
So curious about this now. What do you see on the docket? What's the one sleeper amenity that people just don't realize is a really great amenity, but it's coming up? What's the big thing right now?
Yeah, I can't argue with the indoor swimming pool. And I know it's what movie theaters were 4 years ago to Gatlinburg is now becoming table stakes. I think because it's in its own territory and no other market is really grabbing indoor pools by the threshold. But you can see pockets of this in the Poconos, Hocking Hills, some of these other select markets where there's a one guy or a two guy that has it, and they're just getting an outsized premium above the regular swimming pool guy. And so to me, it's not cheap, but I do think it's one of those amenities that's just going to set you apart. And Gatlinburg's proven it out. And now it's almost becoming table stakes that if you don't have an indoor pool, you're going to struggle. And so you take that whole philosophy and go apply it to a lot of these other markets. And I think nobody has grabbed that amenity at scale by the horns outside of the Smokies. So I think that's the one I would really focus on. Again, large capital investment, but the data proves it is paying for itself hand over fist.
Because people can comfortably swim in the pool, not be outside, even if it's heated. But you're outside. That makes sense. We don't need those in Joshua Tree because it's always nice outside for the most part. So cool. Now, last question. People are probably like, oh, wow, this is amazing. Taylor, I don't want to do this by myself. Or I want to follow you for your statistics on LinkedIn or whatnot. How can people connect with you?
Yeah, man. So I typically hang out on the copywriting sites. So X, formerly Twitter, at Mr. Jones STRs, or just my name, Taylor Jones on LinkedIn. One of these days, I'll come join the Instagram and YouTubes and TikToks, the video forward platform. So I've been writing about short-term rentals for 3 years. So it's kind of the good news is I post every day on LinkedIn and Twitter, just writing about short-term rentals, whether it's data, my journey, what I'm seeing in the market, other investors. So always kind of sharing and giving back from my seat at the table as I see it. But yeah, man, feel free to reach out, send me a DM or follow me on LinkedIn or Twitter.
Cool. And if people want to work with you with STR search?
Yeah, certainly. Happy to help anybody who wants data backing to make a high ROI decision, whether it, again, is narrowing down markets, finding the best properties within said markets, understanding what amenities or design it's going to take, and how to ultimately set it up operationally for success. Feel free to book a call. We've got a Calendly right on the website, strsearch.com. One of our team members will talk through your individual situation, see if we can put together a package to help you on your investing journey.
Sweet, man. Thank you so much for sharing all this knowledge. I would, at the very least, just follow for LinkedIn because that's just my whole feed basically is you.
Appreciate it, man. Appreciate it.
But yeah, thank you so much for sharing the knowledge, man. And yeah, we'll chit chat later, all right?
Thanks, Patrick. Enjoyed it.
And that's a wrap. Thank you for listening to the Patrick Real Estate Show. If you found this episode helpful, please give us a follow and leave us a 5-star review. Your support truly means a lot. And connect with Patrick in the show notes below. Until next time.